Hi, everybody. I'm excited to have this panel today. The topic of our panel today is building the capital stack for emerging markets, right? Debt, equity, and private credit. And I'm joined here with our panelists. I'm pretty excited to have this group. This group, actually, interesting, has a lot of things in common. First and foremost, all three of you have had very traditional sort of finance, institutional finance roles previously, and today are in now more entrepreneurial sort of investment vehicles. So I'll start with you, Pankaj. You started in initially JP Morgan, right? And then LTCM, thank you. And then going on to heading sort of more entrepreneurially, sort of 500 startups in India, and now today your own fund, right? And Elena, you previously were in emerging markets trading at Cargill, and then into derivatives, FX, right? And then and at JP Morgan, right? And Lehman, in Goldman, in Goldman, and then now today, right? In the investments team at CIM for a lot of emerging markets, but it's also sort of a debt fund. And then finally, we have Jerry, who's come out of university endowments from Wesleyan, and then also Notre Dame. And then today you have sort of an interesting sort of mixed sort of multi-strategy approach with venture capital, as well as with private credit. So that's sort of the first thing that all three of you have in common. The second is that all three of you are based here out of New York City, but also have a strong sort of emerging markets corridor as sort of the third part that you guys are sort of keep all of us sort of connected. So without further ado, I'll just directly go into some of the questions. So how did you sort of start to do emerging markets, and how are you doing that from New York City?
Sure. Well, I am emerging markets. I'm Russian, so I have always had interest in that, and my professional career has always kind of led me to that. Cargill is still one of the biggest private companies that deals and trades with all the emerging market countries. Then I went to, again, at Goldman and at Lehman, always focused on emerging markets. So I had like a very deep structured products expertise that I later on took by creating a private credit fund that did targeted investments into SMEs in Latin America, and now I'm at a different firm that does structured asset-backed lending to fintech startups in both US, Canada, and global emerging markets. I focus on our emerging market portfolio. We have a separate US and Canada portfolio, and there we support fintech startups, mostly lenders, companies that originate liquid assets, semi-liquid assets, can be different assets that we can fund, and those assets can serve as collateral, basically, on our debt stack.
My journey is a little bit weirder. I moved to India in 2007 to do a startup, and probably the stupidest thing I could have done, because there was really nothing going on. There was 5 million internet users in the country, and I said, I'm going to start an internet business. Probably about 7 or 8 years too early, but through that, I just got involved with a lot of community stuff and building support systems and infrastructure for other entrepreneurs, and basically said, hey, don't do what I did. And through that, I just got to know a lot of founders across the country, and that accidentally led to venture. So I helped launch one of the first corporate accelerator programs in India, run by Times Internet, and then I joined 500 startups, and I did all the investments for 500 startups in India for about 4 years, and somewhere in the middle, I moved back to New York, and a couple of years ago, I said, I did the opposite thing. I moved to India and tried to start a business there, and I wished I would have had all the support. There's a lot of founders that I saw through my 500 portfolio that were doing the India to US cross-border, and we were able to provide them with infrastructure and support and get them integrated in and really understand how to build a business here. So I said, well, why not keep doing what I've been doing? And so I started a fund a couple of years ago to do that. Exactly. So startups from India building for the US market.
Okay. Well, I'm originally from China, so that's just naturally. I go back. Used to be like twice a year. Now every 2-3 years. I started my venture career in China too. That was 20 years ago when Silicon Valley firms first raised China funds. I joined them back then. While I was at endowments, I covered emerging market, mostly Asia, venture, private equity, hedge funds, a little bit real estate too. So another connection is I started a startup in Beijing about 10 years ago. It was fintech startup and allocating capital into the US. So that's the connection. So for our venture fund, we are about half US, half emerging market, Southeast Asia, MENA, LATAM. And for our private credit fund, we're 100% emerging markets. And so it's just, I have to travel around the world and visit those markets. Used to be twice a year, now it's like every year and a half or so.
It's exciting to hear that half of your fund is in emerging markets for private credit. So for most emerging market companies, I mean, the majority of financing is still VC, and sometimes some amount of sort of supply chain finance. So, compared to the US, right, where they have kind of access to significantly more stacks. So I'm wondering, how have your companies sort of financed themselves? What are sort of their combinations that you've seen, at least in your portfolio, or companies that you've come across?
We invest in pre-seed stage, so very early. Many of our portfolio companies, they bootstrap, to get it started, because emerging market, angel, what we call angel here, is pretty rare. They usually just, fund from family or so. So we go in early, and then it's just capital flows. So before allocating, I was on the limited partner side. For me, just writing checks. I didn't feel the impact in the startup ecosystem. Now, as a VC, I can definitely feel. So for example, we invest in Pakistan, and there's one quarter, I remember it's Q1 2023. We were the only investment in that quarter of the whole country. It's just crazy. So the capital flows to and from emerging market is crazy. It's hard to control. So we'll just ask our portfolio company, you have to plan well, and how do you plan to use this small pre-seed money, usually $500,000, $1 million, how do you stretch that? And where's your break-even point? It's just totally different from Silicon Valley. You just burn through 12, 18 months of, and then that's it. For emerging markets, totally different. And then our private credit fund helps too. Some government grants, and particularly from NGOs, some European, US NGOs, you can get, it's not free money, but literally it's not diluting capital. It's very, very difficult. We invest mostly East Coast too. Compared to Silicon Valley, I can feel early stage capital is pretty rare compared to Silicon Valley. And you got leverage buyouts, and you got private equity, you got IPOs, but for pre-seed round, seed round, I feel it's harder than Silicon Valley in the markets.
For us, it's very important, of course, to have us as a debt provider. It's important for the companies to have equity. So that's why we are working very closely with people like yourselves, with Orbit and other VC companies, to ensure that their portfolio companies now have a different capability of scaling and growing, and very frequently, depending on the nature of your business, debt is a very efficient way of demonstrating scale. So I view it as, where we come in, private credit, ABS is right post-equity. With equity, the company starts up, their seed capital, product market fit is established. Once this is done, private capital comes in emerging markets, helps the company to demonstrate and scale its premise, its whole value proposition. And success for us is that we are preparing these companies for institutional capital to come in. We are this layer in the company's growth journey where they are not yet on the radar of banks or local financial institutions. So we help companies get there, have enough portfolio, have enough scale and demonstrated success where people like JP Morgans of this world or local BBVA banks can come in, refinance us, and continue with this growth journey for the companies.
So I'll talk about India a little bit specifically. I think the India story is a little bit more nuanced, and there's been a lot of development that's happened over the last 18 years, 19 years that I've seen. Private debt has become very common there. Usually it's post-Series A, Series B, Series C. Usually it's accompanied by a top-tier venture fund that's leading a round, and some portion of that round will be private debt. A lot of private equity shops, both international ones as well as domestically grown private equity shops, are starting to get engaged at different layers of the capital stack as well. They'll go on the equity side as well as the debt side as well. So I think founders in India have a lot more options today than they did maybe even 7 or 8 years ago. I think one of the things that I still see a lot of companies struggle with is companies that aren't post-Series A. They're doing well, but they're not a rocket ship. And some of them are getting into this whole working capital issue where they might need like maybe a few $100,000, maybe $1 million of working capital, and they can't get access to that through traditional banking means. So they're going through NBFCs in some cases where we would qualify some of those rates as usury, but that's one area where I think there's an opportunity for folks to come in and create products. Like we understand how digital marketing works today, right? So if you have a way of saying, okay, if you're going to be marketing on Google and you're doing Google AdWords, great. We understand how that works. We understand what kind of ROI you should be seeing, so we're able to lend against that. So I think there's an opportunity there for a lot of companies that are not Series A or Series B yet, but they need some working capital, not a large amount.
Interesting. Lending, though, against sort of marketing performance.
Yeah.
Interesting.
Yeah.
Okay. So, I mean, what I'm hearing so far, right, when you think about the stack, right, is then initially still very early stage investment, then some amount of debt, but then with the sort of confidence that there's going to be another venture round afterwards. And then at the same time is by that point, more likely to see some amount of working capital on maybe more creative ways like marketing, sort of against like performance marketing results.
Like I don't see companies that are Series A and they've found product market fit or they're close to it having that much of a problem accessing capital. There's top tier capital and then there's other expensive forms of capital. They can access a lot of that, but it's those guys that are really early and there's stuff that's working, but they can't really say that they've got product market fit. I think those are the ones that are still constrained when it comes to capital.
Okay. And so mindful of time, I have one last question. So LPs generally want their returns in US dollars, but for emerging markets, right, transactions are in local currency. So how do you manage those expectations?
Super relevant question. Absolutely. There's a lot of volatility, obviously. And we prefer to take no FX risk at all. There are different strategies, of course. There are some lenders that are local currency lenders. Even if we do lend in local currency, we would hedge out risk completely. We work with a lot of esteemed partners that help us hedge out this risk. Or we would always, if we lend in dollars, which is most of the time we do, we lend in dollars, and then we require our portfolio companies to fully hedge out the risk, because the idea is that, the talent that we're investing in, they are good at whatever business that they're building, and not necessarily at anticipating market moves. So we've seen a number of companies that were close to literally collapsing just because of their FX exposures that were unmitigated and not met. So for us, it's non-negotiable that everything has to be hedged out.
Short answer for how do we manage emerging market currency risk is we don't. We lend, our per-capita fund lend 100% US dollars. And for venture, it's 100% USD in, USD out. And we only invest in those emerging markets who are registered in sovereign hubs like Singapore, Hong Kong, sometimes Cayman. And if we invest in Indonesia startup, it has to be registered in Cayman or Hong Kong. For Pakistan, it has to be Singapore. They have treaties in how you move currencies through those quotas. And we encounter some, Indian startups, and it's local company registered locally. They only take local currency, rupees. That we had to walk away. And no matter how good the team is, and how promising startup is. So we just have to actively taking that kind of risk. And our portfolio companies at a certain stage, after Series A, Series B, they can hedge, through the International Bank, CD, HSBC. But most of our startups, they just have to take that kind of risk. One example would be we invest in Nigeria. During pandemic, the Naira depreciated 40% one year, and 40%, another 40% next year. So it's just like half the money are gone. And they have to, the local currency has to keep compounding and grow faster than depreciation in order to return our money. So that's just a reality. And fortunately, in those market, they do grow fast. And also, as a venture capital, you're actively taking that risk. That's a risk I'm willing to take, other than governance risk or and compliance risk or technology risk.
I think for me, it's a little bit different because as a traditional early stage VC, I'm a US-based fund. All my LPs invest in dollars. I deal with the India companies and whatever taxes need to be paid there and all that stuff. But when I'm doing an investment, one of the things that I'm thinking about is when I started investing in India, there were 0 unicorns in the country. Today, there's about 170 or so unicorns in the country. And back then, great companies were raising at a valuation of $100,000 on their first round. Right today, those same companies are raising at a 10 or 12 million. So it's very similar to where numbers are here, a little bit lower, but not 80% lower or 90% lower. So when I'm investing, I'm factoring that in and saying, at the same time, when I started investing in India, the dollar was 39 rupees. Today it's 95, right? So I have to take that into account, knowing that, all right, look, if I think that this investment could generate a 50x return in rupee terms, and if I look at the continued devaluation of the rupee over the next 10 years or so, where do I think it's going to be? 120? Okay, at 120, am I going to get a 30x return? If the answer is yes, maybe it's worth doing the investment. If I'm going to get a 5x return, it's not worth doing the investment. That's how I look at it.
Yeah, definitely have to factor it in. I get a lot of that question too, like, oh, how do we manage that risk too? Yeah. Okay, that's all the time we have for today's panel. Thank you so much.
Thank you.